Now, gold remains in and hovering around record territory, trading above the $5,000 mark U.S. despite a slight pullback. It's hanging in right now, still up there, even though it's off today by 0.28%, but in and around $5,084 an ounce. All this following strong U.S. jobs data. Let's get more now from Rick Rule, President and CEO of Rule Investment Media. Rick, thanks very much for joining us.
Roger, thank you for having me.
It's a bit of an interesting day. We saw the stronger than expected jobs numbers yesterday, but markets are off today. Gold's off a little bit. Your thoughts on where gold is right now? Where do you see it heading?
I think the fundamentals for the precious metals market are very much intact. Gold has done well historically, and I use gold to refer to the whole precious metals category. When people are concerned about the maintenance of their purchasing power in conventional savings instruments, fiat currency denominated savings instruments, I think those fears are very real. Debt, deficits, the unsustainability of entitlements, the citizens' expectations on both sides of the 49th parallel relative to society's ability to afford them tells me, sadly, that precious metals will do well for 10 years. When I say sadly, I mean the reason that they do well is usually because of the softness or weakness in more conventional savings and investment assets, a trend which I think continues. That notwithstanding, the gold and silver prices have moved very, very, very quickly in the last 18 months. And I think the pause that you've seen, in fact, some of the decline that you've seen is normal and necessary if we look at past bull markets.
First of all, what gives you the confidence for 10? You say 10 years you can see gold rising still and precious metals?
Yeah, I don't see any resolution of our fiscal problems. I don't want to speak to Canadian numbers because I'm not Canadian. But in the U.S., the on-balance sheet obligations of the U.S. government exceed $39 trillion, while the net present value of U.S. entitlements is $120 trillion. The combined number, $159 trillion, when juxtaposed to the private net worth, the total private net worth of the American citizenry at $167 trillion, tells you how perilously close we are to being unable to afford the level of government that we have. The alternative to that, I think, is really a slow motion default, a default that takes place by lowering the real purchasing power of the U.S. dollars. There's an analog for this. In the decade of the 1970s, according to the U.S. Office of Management and Budget, the purchasing power of the U.S. dollar declined by 75% over 10 short years. Wow. Not surprisingly, the gold price increased 26-fold in those 10 years. By the way, Roger, I'm not suggesting that the gold price goes up 26 times from here.
I can't even do the math on that right now.
The resolution of our inability to afford to spend at the pace that we're spending. The resolution of that has to be either a default, which I don't think happens, or a decline in the purchasing power of the U.S. dollar. And I think the latter is likely. I think the U.S. dollar will do okay relative to other fiat currencies, but I think it will do absolutely poorly. And I think as a consequence of that, gold and silver will do relatively well.
And when you say relatively well, I mean, obviously not, it was 36 times, I think you said, the gold increase in that decade. We're not expecting that, but where do you see gold heading?
It would not surprise me. I'm too old to give you a numerical guess. It would not surprise me to see the nominal price of gold mirror the decline in purchasing power of the U.S. dollar. If the U.S. dollar declined in purchasing power by 75%, a twofold or threefold or fourfold increase in the price of gold over 10 years in nominal terms, I think is a reasonable expectation.
And if you're investing, if you don't have gold right now, is it still worth trying to get in?
Absolutely. I am not somebody who buys gold as an investment. I save in gold. I mean, pardon me, I maintain liquidity in U.S. dollars, which means that I have been periodically accumulating gold really since the year 2000. I wouldn't encourage somebody to go all in on gold at any point in time. I would urge people to understand that this is a core savings product. It is a medium of exchange that's simultaneously a store of value, unlike other currencies.
All right, and let's just quickly shift before we run out of time here. Let's get your thoughts on some oil right now, Canadian oil, investing in that. Where are your thoughts on that?
Oil is one of the few unloved commodities left. The U.S. oil industry is priced at a discount to its net present value at $60 oil, and the Canadian industry is selling at a discount to the U.S. prices. The challenge in Canada, of course, is political. The Canadian political elites for the last decade have been hostile to the most efficient industry in Canada. The recent exchange in Ottawa between noted Canadian oil analyst Eric Nuttall and an MP for Quebec is telling. The Quebec MP said that he doesn't understand how it's in the public interest to build out oil and gas infrastructure. And Mr. Nuttall responded that he should be aware that the entirety of the equalization payments that keep Quebec afloat comes from oil and gas. That's the nature of the political discussion. If the political discussion in Canada begins to revolve around solvency, then the Canadian political elites become much more accommodative to Canadian oil and gas. The Canadian oil and gas industry is selling at a discount to the U.S. industry. It has more undeveloped locations than the U.S. industry does. And Canadian talent, which is to say the human resources around oil and gas, is absolutely world class. The stage is set for a real rebound. The only risk left is political.
Okay, we'll have to leave it there. But Rick, thanks as always for joining us.
A pleasure. Thank you for having me back.
Rick Rule is president and CEO of Rule Investment Media.